47 million ounces of silver vanished from the biggest exchange vault in the world in just 4 days. Not over months, not over weeks, 4 trading days, December 2 to December 6, 2025. And right now, as I speak this, the biggest banks are quietly positioning for what comes next. The media is calling it a rally, a nice little price increase in a boring commodity market, but they are missing the point entirely. What happened in December 2025 was not a speculative bubble forming. It was the moment when an invisible crisis became visible. It was the moment when structural shortage became undeniable fact. And it is just the beginning of something that will reshape markets, supply chains, and global manufacturing for the next 5 years. Before we get into what just happened, you need to understand what has been building invisibly for 5 years, since 2020. A deficit that nobody talked about, a drain that nobody wanted to admit, and a supply crisis that the entire financial system is about to wake up to, whether they want to or not. In early December 2025, COMEX maintained roughly 113 million ounces of registered silver. That is the only supply immediately available for futures delivery. Everything else was theoretical, paper claims, promises. But registered? That metal you can actually take delivery of. Then something changed. Starting December 2, people began demanding physical delivery. Not trading, not speculating. They wanted the actual metal in their hands. By December 6, over 60% of that registered inventory was gone. Claimed, removed from vaults. 47.6 million ounces. Let me put that in perspective. That is more silver leaving vaults in 4 days than typically drains in 3 months. The drain rate was historically unprecedented. COMEX registered inventory has collapsed 73% since 2020. Not gradually, not in small steps. 73% gone. And the remaining registered inventory now represents only 3 weeks of global industrial consumption. 3 weeks. Think about that for a moment. The world's largest futures exchange for silver now covers only 3 weeks of what the world needs. When the math gets this tight, you are not looking at a market imbalance. You're looking at a ticking timer. But the problem goes far deeper than COMEX. Shanghai inventories fell below 446 tons in early December. That is the lowest level since 2016. London vaults have contracted 31% from their peak in April 2020, and global available mobile stock, the supply actually accessible to markets, has contracted over 1 billion ounces since 2019. 1 billion ounces. That is an entire year of global production just vanished from accessible supply. This is not theoretical. This is documented. This is visible in the vault data that the exchanges publish every single week. But almost nobody was watching. Almost nobody cared. Until December 2025, when the data became so extreme that even the paper markets could not ignore it anymore. Here is what nobody wants to talk about. The silver market has experienced 5 consecutive years of structural deficits. 2021 through 2025, cumulative shortfall of nearly 820 million ounces. 820 million. That is not a rounding error. That is not a minor imbalance. That is a mountain of missing supply that has been building year after year after year. And the worst part, these deficits persist despite silver prices doubling. In December 2024, silver was $30 per ounce. In December 2025, it hit $63. The price doubled. Supply did not budge. Mine production remained flat. That is the death knell of traditional market equilibrium. When prices can double and supply does not respond, you're dealing with a constraint that money cannot solve. You're dealing with absolute scarcity. Global silver mine production has remained essentially flat at 813 to 835 million ounces annually, despite a 107% price increase. In normal markets, this would be impossible. Higher prices attract investment. Investment attracts miners. Miners increase production. But that is not happening, and here is why. New silver mines take 7 to 10 years from development to production. The project pipeline is empty. Mexico, the world's largest producer, is watching mines close. San Julian ends in 2027. Mercedes, Bolañitos, San Rafael, Dolores, San Dimas, all closing. Peru is facing similar closures. Bolivia even worse. Production is going to decline at a rate of negative 0.9% per year from 2025 through 2030. More capacity is disappearing than new capacity is being built. And you cannot rush a mine. You cannot compress 10 years of development into 2 years because the market is tight. The law of physics does not negotiate. Now you might think recycling could offset this. Silver recycling is growing at 4.51% per year. By 2035, it will be a $16 billion industry. That sounds impressive until you do the math. Recycling contributes only 150 million ounces annually. The annual deficit is 95 to 149 million ounces. Even if recycling grows perfectly, even if everything goes right, it closes only a portion of the gap. The problem? Recovery rates from electronics are only 20%. Solar panels lock silver away for 25 years. Long-term supply contracts prevent recycling material from flowing back to the market. Global supply mining plus recycling totals approximately 963 to 985 million ounces annually. Global demand exceeds 1.2 billion ounces. The math is stark. Supply cannot meet demand. It never will at current price levels. Something has to give. But here's the critical part that changes everything. Demand is not going down. It is accelerating. Solar photovoltaics consumed 17% of all industrial silver demand in 2024, up from 11% in 2014. That is a 55% increase in market share in just one decade. And it is accelerating. New advanced solar technology called TOPCon requires up to 50% more silver per panel than traditional cells. This creates a paradox. Efficiency improvements actually increase silver intensity. Technology improvements drive demand higher. China increased solar capacity 45% year over year. The European Union has mandated 700 gigawatts of solar capacity by 2030. This is not market demand, this is policy. This is government mandate. You cannot reduce government mandates because silver got expensive. Then there are electric vehicles. EVs use 67 to 79% more silver than combustion engine vehicles, 25 to 50 grams per vehicle. Global EV production will more than double by 2030. EVs will account for 59% of automotive silver demand by 2031. Governments have mandated internal combustion phase-outs. There is no reversing this transition. EV silver demand grows 3.4% per year, independent of price. Add to this AI data centers, 5G infrastructure, advanced semiconductors. These are new sources of silver demand that barely existed 5 years ago. An estimated 665 million ounces of silver demand comes from industrial applications. And this floor is rising, not falling, regardless of price. This is the critical distinction. Investment demand can contract during market corrections. People panic, they sell, demand drops. But industrial demand does not work that way. Solar manufacturers have long-term contracts. EV makers have committed production roadmaps. Governments have net zero mandates written into law. You cannot engineer around silvery electrical and thermal conductivity are irreplaceable. These requirements are locked in through government mandate, long-term contract, and physical law. That demand cannot evaporate. Now watch what happened with the paper markets. Silver entered historic backwardation in December 2025. Spot prices trading above futures prices. That is backwards. That never happens under normal conditions. Futures should trade higher because of storage and financing costs. But when spot trades above futures, it means people are paying premium for immediate physical possession over future promises. During the December rally, silver futures premiums reached 30 cents over spot in select deliveries. That is a signal associated with intense bull markets like 2011 when silver hit $49. This backwardation persists despite daily price increases on December 15th that were 3.35%. People are still paying premium for physical. That means they do not trust the paper system. They want metal they can hold. Physical premiums on coins and bars have exploded from $3 to $5 over spot in normal times to $15 to $30 in December 2025. Dealers are reporting inventory shortages. Mints have multi-month waiting lists. Premiums on specialized products are approaching $50 per ounce. This is not normal. This is panic. This is the market recognizing that physical supply is truly constrained. COMEX maintains two categories of inventory. Registered, which is about 79 to 113 million ounces immediately available, and eligible, which is stored but not immediately deliverable, about 526 million ounces. The ratio has collapsed to historic extremes. Registered now represents only 11.1 to 13% of total metal stored. This creates a critical vulnerability. Even if eligible inventory nominally covers months of delivery, converting it to registered status takes time, creates bottlenecks, causes delays. And when you need metal now and only 3 weeks worth is available, the system breaks. Silver's 107.56% return over 12 months appears dramatic, but it lags the underlying supply deterioration. The paper futures price rose 107%, but registered inventory declined 73%, and the structural deficit accumulated to 800 million ounces. The price has not closed the gap. It has only begun to reflect the underlying shortage. The December 2025 rally did not happen in isolation. Multiple catalysts converged. Manufacturing data showed weakness. The Empire State Manufacturing Survey revealed deeper factory contraction. Bond yields collapsed. Real yields compressed. Suddenly, physical assets became attractive. The Federal Reserve was expected to cut rates. That boosted demand for non-yielding assets like silver. The COMEX vault drain became public knowledge. Media coverage reached critical mass. Institutional investors recognized that maybe the exchange vaults were actually empty. The gold-to-silver ratio compressed from 80 down to 67.72. That signals aggressive capital flowing from gold into the more volatile industrial metal. Shanghai inventory news hit. Stocks fell to 2016 lows, 446 tons. Global supply concerns crystallized. All of this happened in December. All of it converged at once. But here is what people got wrong about this rally. They see a price increase and assume it is nearing exhaustion. They think the speculative excess will soon correct. But the December rally was not the peak. It was the first recognition phase. It was the moment when hidden became visible, when invisible became undeniable, when structural shortage stopped being theory and became documented fact. Physical scarcity is now undeniable. COMEX vault drain is publicly documented. A 73% inventory decline since 2020 is mathematical reality. Industrial demand is locked in through government mandate and long-term contract. Solar and EV deployments are contractually obligated. They will not reverse because metal got expensive. Mine production is stagnating. No new large-scale mines produced before 2027 to 2030. Recycling cannot close the gap. Even growing at optimal rates, it lags the deficit by 100 million ounces per year. Price elasticity is exhausted. A 107% price increase did not expand supply. That means further price increases are required. System fragmentation is beginning. Backwardation and physical premiums mean the paper market is losing relevance. Structural deficit will accumulate. Even if 2026 deficit narrows to 95 million ounces, cumulative deficits through 2030 total 500 million ounces. That is 6 months of global consumption. This must be funded through price increases or system failure. In 1979 and 1980, the Hunt brothers tried to corner silver. They accumulated 200 million ounces. They demanded delivery. The system panicked. COMEX changed the rules. Margin requirements skyrocketed. Trading halted. Position limits were imposed. The Hunt brothers lost billions. But here's what people forget. The people holding physical silver, actual metal in hand, came out fine. Silver crashed on paper from $49 to $10. But people who bought at $6 still made enormous gains. The system could change the rules on paper, but the system could not create silver it did not have. Today is different. The Hunt squeeze was artificial scarcity. 2 men accumulating metal. 2025 is genuine scarcity. Industrial demand cannot be reversed. Government mandates cannot be suspended. Mining capacity cannot materialize overnight. Recycling cannot accelerate beyond infrastructure limits. This is not speculation. This is reality. And the system cannot rule its way out of reality. As registered inventory drains, COMEX faces an accelerating dilemma. History shows exchanges implement defensive measures. Margin increases, position limits, trading halts, cash settlement. But none of these address the underlying deficit. Cash settlement at $65 does not provide physical silver to manufacturers who need it for production. This creates separation. Paper silver subject to regulation and rule changes. Physical silver subject only to scarcity and supply. This divergence is beginning. Spot premiums up to $50 signal it. Year-long waiting lists at mints signal it. Bank suspensions of silver sales signal it. The divergence will accelerate. Analyst projections range from $65 to $100 per ounce by 2026. Bank of America positioning 65 as a floor. BNP Paribas suggesting potential for 100 as institutional capital recognizes the supply trap. These are not speculative targets. These are price levels required to rebalance markets where supply is absolutely constrained and demand is structurally non-negotiable. 3 scenarios for 2026. Base case at 60% probability. Silver reaches $75 to $85 by Q2 2026. COMEX faces delivery pressures. Cash settlement becomes routine. Physical premiums remain elevated at $10 to $20. Industrial users accelerate recycling investments, but the structural deficit remains unresolved. Stress case at 25% probability. Silver reaches $100 to $125. Institutional capitulation drives ETF inflows. COMEX suspends delivery. Forced cash settlement triggers legal challenges. Physical market completely separates from futures. Manufacturing faces procurement crises. Government intervention through strategic reserves becomes likely. Regulatory case at 15% probability. U.S. government releases strategic mineral reserve stocks. China and Russia restrict exports. Supply becomes explicitly geopolitical. Supply contracts are renegotiated or broken. Demand substitution accelerates through desperation. The window of December 2025 through 2026 will be remembered as the inflection point where invisible constraints became visible reality, where vault drain data eliminated all doubt, where structural shortage stopped being theory and became the framework for understanding market prices for the next 5 years. December 2025 was not the peak. It was the opening. Silver prices at $63 reflect early stages of repricing that will likely continue exerting upward pressure through 2030. The December vault drain was not the cause. It was evidence. Evidence of a crisis building invisibly for 5 years, now visible to anyone paying attention. The math is simple. Supply is constrained. Demand is locked in. Inventory has collapsed. Therefore, prices must rise until they ration demand or create substitution. There is no other mechanism. There is no negotiation with physics. There is no rule change that creates silver when mines are not producing it. People think of silver as a commodity. They think supply will rise to meet demand. But supply cannot rise. The capacity does not exist. The timeline does not allow it. The geology does not support it. What rises instead is price. And when price rises far enough, behavior changes. Industrial users implement recycling. Demand substitution accelerates. Consumption patterns shift. But getting there requires price moving from $63 to levels that most people think are impossible. Levels like 100, levels like 150, levels that appear extreme until you realize the alternative is system failure. No physical delivery, manufacturing shortages, supply rationing, government intervention. Choose one. The market is choosing price discovery, higher silver prices by a lot. The December rally was the first step. The December 2026 rally will be even larger. And the pattern will repeat every 6 months as the market slowly, painfully reprices what should have repriced over 5 years of warnings. Nobody was watching. Now everyone is watching. And the vault doors are closing. If this explains something that changes how you see the commodity markets, if you understand now why industrial demand locked in through government mandate cannot be reversed, subscribe. Because what comes next in the base metals market makes silver look like a warm-up. We are about to face supply crises in copper, in cobalt, in lithium, in rare earths. In every critical material, the world bet on becoming cheap forever. That bet is ending, and the repricing has only started. The clock is ticking. Physical supply is finite. The window to understand this is closing fast.